We move on next to our startup called 3rd-eyes Analytics, and they're offering financial institutions a modular and flexible white-labeled SaaS solution to automate wealth planning. We're going to put them online. Hello. How are you?
Hello, good morning.
Are you ready to go?
Absolutely.
Your time starts now. 5 minutes. Over to you.
Thank you. Hello. My name is Mark Mettler. I lead business development at 3rd-eyes Analytics. I represent the wealth tech that translates how climate change impacts personal wealth and financial goals of investors. We make this transparent and help financial institutions to change their clients' investment behavior towards a more sustainable future. Despite a lot of data, it remains unclear how investors shall streamline their investment decisions in light of climate change. Let's have a closer look how climate change affects investors. We know from extensive academic research that significant climate change will affect economic growth. This was demonstrated by Professor William Nordhaus from Yale University. He has won the Nobel Prize in 2018 by demonstrating that rising temperatures affect GDP growth significantly if they exceed 2 degrees Celsius. We also know from research that economic growth is a key variable in explaining the expected returns of different asset classes. Therefore, if a rising temperature reduces economic growth and consequently investment returns, this also directly affects investors. We offer financial institutions various solutions and capabilities for wealth and life planning. They realistically and instantly simulate wealth development and goal achievement in thousands of scenarios, including fat tails and climate change. Our solutions optimize the strategic asset allocation to maximize goal achievement of clients and enable the mitigation of climate change impact as part of the portfolio construction. Let's have a short look at our solution for advisors of financial institutions. Our client is Lisa, with bankable assets of 835,000 euros that can be reallocated into an optimal asset allocation. Lisa's bankable assets consist of cash, equities, and bonds, and she owns an apartment valued at €250,000, leading to total net wealth of a bit more than €1 million. Lisa regularly saves €250 per month and has the following financial goals. She wants to ensure that she can keep her living standard during retirement with €6,000 per month and preserve a capital of €200,000 over her entire lifetime to have a cash reserve at all times. On the right side, we see her wealth development in thousands of capital market scenarios, while 3 scenarios are outlined: the expected case, the good case, and the adverse case. Below, the green bars indicate that Lisa can reach her goals in the expected capital market scenario, but has a financing gap in the adverse capital market scenario of around €300,000. Looking at how a 3-degree temperature increase affects Lisa's situation, we see that she can no longer achieve her goals in the expected capital market scenario. The financing gap in the adverse capital market scenario increases, and she now has a liquidity problem at the age of 77. If we optimize her situation by means of a bespoke strategic asset allocation, we see that the new asset allocation improves her goal achievement, both in the expected scenario as well as in the adverse capital market scenario. This might be surprising, as the new optimized asset allocation on the right side, which we see just afterwards, includes more equities and less cash and bonds, which we see just now. Fact is that the long time horizon is beneficial for Lisa to finance her living standard until expected end of life, even in the very adverse capital market scenario that considers non-normally distributed returns. So the question now is how to create a portfolio out of this optimized strategic asset allocation. For this purpose, Lisa can indicate her investment preferences, not only in the ESG context, but many more. Based on those preferences, she gets a bespoke investment proposals that answers why a specific investment product has been selected for her. The matching score that you see answers how well an investment product fits her investment preferences, while the quality score outlines the quality of the product. And these two combined lead to the best fit score, which serves as basis for the investment product recommendation. This is how we at 3rd-eyes Analytics use existing climate-related data to help financial institutions streamlining investment decisions for their private and institutional clients. Why is this all credible and relevant? Well, because our founders, our head investment center, and our quant team all have decades of experience both in financial modeling and sustainable investing. Climate change has a significant impact on personal wealth and financial goals of your clients. Let us help you to make this transparent in order to change your clients' investment behavior towards a more sustainable future. Thanks a lot for your attention.
Thank you very much. That was 3rd-eyes Analytics for that wonderful pitch. And now we go to the judges for a 5-minute Q&A. Judges, do you have any questions? Please raise your hand in the chat room and we'll try to get to all your questions. We're just checking in with the judges right now. Let's see who has a question. Hugh, I do believe Hugh has a question. Please go ahead, Hugh.
Thanks, great presentation. I'm interested how you get high enough quality information about the investments to make the added value decisions you make. Just something about how it works. Thanks.
If you talk about the investments, do you mean on basis of strategic asset allocation or investment products?
The investment products.
Okay, investment products, we source the data from various data providers. That's one option. So be it Morningstar or Fund Express. So that depends on the wishes of our B2B clients, or we include their in-house research. That's completely up to them. So we're a SaaS provider and have a lot of flexibility in this regard.
Thank you for that. And I do believe we have a question from Winnie. Over to you, Winnie.
I think this is truly important for the future of investment. But I'm curious, how do you, I mean, for a global investor or institutional investor, I think this is a very important key to answering the questions for investors. But how do you whittle it down to an individual investor and how it actually affects a portfolio in such detail? Thank you.
So what are we doing? Well, first of all, we create the scenario space for each B2B client that includes the asset classes of that specific B2B clients, normally the basis of what their clients have in their portfolios. And then we simulate based on the indices agreed on with that relevant B2B provider. We simulate the wealth development in thousands of capital market scenarios in a multi-period manner. So we model, for example, negative to positive interest rate transitions based on a Monte Carlo approach in a multi-period manner. And we include the different distribution curves of the asset classes which are non-normally distributed. So the goal is really to, as realistically as possible, simulate capital market developments or, in the end, then client portfolio wealth developments. Does that answer the question?
It does, but I guess my question then would go into the secret sauce. But here's another way of asking. Because as an individual investor, I only make up a very small microcosm of a larger asset management piece for an institutional investor or asset manager. So how do you actually make that a realistic kind of like how is it even practical for me if I had like $50,000 with a investor? How does it even make sense? Because, you know, when you talk about climate risk, we're not even going to transition risk or actual physical risk. So how do you actually make that number realistic? Because I will also face other things like interest rates, variation, maybe it's just an industry trend, maybe it's just market risk. How do you even make that realistic for me as a 50,000 investor in, say, an asset manager? That's my question, yeah.
If I understand it correctly, you're talking about the diversification on the one hand side, and on the other hand side, what kind of asset and wealth elements do we include? So we are completely holistic. That means we include all asset classes, be it bankable or non-bankable ones. So real estate, private equity, art, all that kind of stuff we include as well. For smaller investors, obviously, as part of the recommendation engine, we ensure sufficient diversification. And that's also done together with the financial institution, that for a smaller client offering, for example, that you use mutual funds which ensure that kind of distribution instead of single stock holdings. I mean, the detailed portfolio construction we also define with the financial institution, and that also allows to tailor the offering to the specific client segments.
Thank you for that. Thank you. We've got about slightly over a minute now. Only time for a quick question, and we've got one from Beatrix. Beatrix, really quickly, please.
Yes, just again on your data feed, you have certain data sources and which you rely on certain data provider by which you mentioned. Just a question, how do you think you develop this further? And we all know that data at the moment are, let's say, less reliable as we would like to have them. What are you doing? You have your own system, methodologies, AI work. That's what I would like to know.
So first of all, as said, we create the scenario space. That scenario space is regularly reviewed with the client. Clients normally once a year. And with regard to data sourcing, that's more focused on the investment product side, obviously. So there we can access any data points available, for example, be it Morningstar or MSCI, depending on the data they expose. And as said, this is always done together with our B2B clients to make sure that it suffices their needs.
Thank you very much. And I believe that's all the time we have. Once again, 3rd-eyes Analytics. Thank you so much for answering our questions and all the best.